Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 3rd of March. We're getting there. It's nearly a quarter of the year in flow. So we're looking at Brent crude oil trading this morning in Asia, little changed at $73 a barrel, give or take a few pennies, despite, you can only say, absolutely dramatic geopolitical headlines over the last few days. Not only headlines, but literally punching matches, or whatever one might diplomatically refer to these events as. But ultimately, a big scramble going on in the Western world to try and maintain some kind of political alignment. Meanwhile, oil markets are yawning. Omar Najia, global head of derivatives at BB Energy, sitting in Dubai in the center of the universe, is literally, although he has his right ear, I can see somewhere in Texas by the map behind him there. I'm not sure if that has any symbolism, but nonetheless, Omar, your thoughts. We are sitting as well this week, Monday morning, the Chinese National People's Congress about to meet their annual big powwow in Beijing. Your thoughts this Monday morning in oil market without a heartbeat, despite the backdrops?
Yeah, I think oil is basically trapped between very strong resistance at the top of it and very strong support at the bottom of it. And that strong resistance support goes back all the way, nearly 2 years, or at least a year and a half. So if WTI can manage to get over this kind of, $75 level, then I think whatever's happening geopolitically, then basically we go up, energy gets released to the upside. And if we can break below the 68.50 level to the downside, then the same thing happens. Now, every day I kind of turn my opinion from bull to bear to bull to bear to bull to bear. Because it's if you look today, China,
If you
I was
say it
initially,
fast enough,
yeah.
bull bear, you might come up with a new word.
Yeah, yeah. So China's going to release, I think a lot of QE today, a lot of stimulus. So that's positive the market. I think the equity markets in the US are positive the market. I think a weakening US dollar is positive the market. But I think basically that the supply quote demand situation is negative the market. So you add it all together, and it's very difficult to kind of get um, a good kind of solid, because when you trade, you need to be convinced. Because if you're not convinced, you're going to be closing and shutting and opening and shutting and all this kind of stuff, which is not what you want to do. You want to go long, be confident, stay long, get longer. You don't want to basically be long, then close, then short, then close, then long, then close. So confidence right now is a bit difficult. And if you look at the price action on the charts, it's all basically forming like indecisive crosses. So you go up, you go down, and you close in the middle. You go up, you go down, you close in the middle. So the market really doesn't know which way to take this market. Again, I
Okay.
mean, yeah.
Let's go to the center of the universe today, which seems to be Beijing, although Victor is instead of Beijing. Victor Yang, senior analyst at JLC Network Technology. Victor, I wanted to get your thoughts. What's the expectation? What do the China National People's Congress need to do you think, or announce, in order for the Chinese consumer to be willing to open their wallets and spend some money?
Well, that's a good question. And I think the most important thing in 2025 is for the ordinary people, for most people, to feel the improvement of the economy and to make the policy benefit them. Well, in 2024, we knew the country's GDP grew 5%, but it was not. Actually, I would be honest to say it was not fair by most people. It was just by a relatively small group of people contributed by, well, high tax, mostly by high tax, driven by high tax. And so one of the focus is how the government can make people believe that it's going to improve significantly and boost their confidence in the country's future in 2025. And is about to release more stimulus this year. For instance, the subsidies on a lot of products, home appliances, laptops, and cell phones, and so on. We had expanded this kind of subsidies this year, and so we expect more stimulus to cover more people. Yes, in 2025.
Michelle Weiss-Bachmann, Principal Analyst, Lloyd's List Intelligence. Michelle, good morning. Your thoughts, I mean, we are Monday morning. We had a big IE week last week in London. There was a lot of chatter about the dark fleet, about the Biden sanctions that came into play after, just in its final days, and the impact it had. And as we saw, oil prices sort of climb very high in a month ago, or sorry, in January on the back of that. Where are we now, sort of 6 weeks later into the Trump administration? That initial sort of belief that these sanctions were going to be quite significant in curtailing supplies. Your thoughts now, 2 months later, what's the picture?
Well, I especially crunched the numbers for you, Sean, this morning, looking at oil.
And that's early morning in London, right? I mean, that's
no, I'm
no.
talking to you from Adelaide, Australia, where I'm
Oh,
temporarily
crikey.
in
Oh, how
France.
lucky are you? How lucky are
Yeah.
you? You've been to the beach already and back and had your barbecue.
Yep. And so I've crunched February numbers. And the extraordinary thing is that because Urals crude has averaged $60 per barrel, $60 a barrel for most of February, means that it was effectively under the price cap. And what's happened is that private Greek ship owners have come in and they have literally saved the day for the Russians because they don't need to source alternative tonnage. The price of Urals is more or less below the cap. And so I analysed the percentage of tankers by beneficial ownership that called there to lift Russian oil and products. And I found that hang on, I'm just going to refer to my notes here. So we had 40% of tonnage, the highest figure in 19 months was Greek owned, and the dark fleet, the percentage that lifted was 38%, which was the lowest in 12 months. So effectively, the lowering of the crude prices has all but rendered those sanctions ineffective. And then you remember, of course, that only the US ones were the stickiest. The EU and UK sanctions, while initially caused some difficulties trading for those that are sanctioned in the dark fleet, they have since sort of recovered from that and kept on going. So when you look at the prospects that for a month-long ceasefire, we can probably start talking about whether or not the G7 price cap, how much longevity does it have? I mean, these are extraordinary events, and I think we have to really quickly reassess oil flows, oil prices, and what a potential lifting of the price cap means now.
And just a quick follow-up on that, Michelle, what impact has that had then on tanker rates, if indeed we've seen such a big push away from the dark fleet?
Well, so I knew you'd ask that. So I had a look at the sanctions premium. And so Urals crude, this is from Argus Media, Urals crude to India, the sanctions premium went from $4.10 a barrel before the January 10 implementation on sanctions to $7.15. So there's a nice, strong, healthy premium. Private Greek ship owners know that they can do it below the cap, and they've gone way in and they've started lifting all that tonnage. The overall global tanker freight rates have moderately lifted in the last month, but that's more part of the usual global upswing as, we sort of come out of that depressed January period. But I have to say, the overall sentiment for tanker earnings isn't that great for a whole lot of reasons, and it's not just to do with the dark fleet and sanctions. There are other supply and demand equations to think about as well.
Omar, listening to that and your earlier comments, it does seem, I mean, the more likelihood is that you had mentioned WTI in that range, 68 on the floor, 75 on the ceiling, that breaking through, that a lot of that narrative seems to be bearish. The more Russian oil that flows, the more supply, obviously, the more bearish. In whatever way the Europeans and the Americans and the Ukrainians get to a position of ceasefire on Ukraine, it's bearish. It's hard to see a bullish tone anywhere in this concoction, unless, as you mentioned, perhaps the stimulus out of China.
Well, I mean, you've got to look at exogenous markets. All other markets, apart from crude, are rallying and rallying hard, right? Inflation is ticking up. Well, in terms of its fundamental price, is cheaper than it was in the, I don't know, 1980s, 1970s, whatever, in real terms. So it's extremely cheap. The talk of sanctions, the EU is putting sanctions on. The UK is, supplying Ukraine with money. I think it's like 3 billion a year for the next 100 years or whatever it is. And they're all under this delusion that they're going to supply troops and I don't know what. And meanwhile, Europe and the UK are left behind because they don't matter anymore. It's only to do with Russia and the US. So they're going to move forwards, I think. But at what speed do they actually go and do this? And are they, so the war in Ukraine is such that the US has to basically capitulate. They have to basically sell Ukraine down the river, and they basically have to say yes to every single last demand of Russia. That simple. So the question is, will they do it or not? If they do, they lift sanctions, blah, 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 blah. But meanwhile, the EU is adding to sanctions, not removing sanctions. The UK is adding to sanctions, not removing sanctions. So you have that. You have basically a situation also in the Middle East. If things start to hot up again and you get this kind of, reigniting of the Iran-Israel kind of thing, that might spook the market. The market sentiment is bearish. The market is short, but what I find interesting is it's not breaking down. So with all this stuff that you hear, you would expect, I mean, last week the market came and touched that 68.50 and bounced straight off it. I mean, $2 higher in a day, right? So if this weakness is there, and so basically what I'm trying to say is the risk that I see is maybe everybody who wanted to sell has sold already, right? So you only need to kind of take it up a little bit, maybe $2-3 a barrel, and they will panic. And that's quote unquote easy money. But if they want to sell, every day that goes by makes it less and less likely because it's there for the taking. It's like you have an open goal, the ball is there, all you need to do is kick it, but they're not doing it. Why?
Because Victor Yang is busy in China finding reasons for them not to. No, Victor, I wanted to get a sense, and it's very difficult to kind of comprehend from a distance, and we are sort of battered with our narratives and prejudices, and generally the tone on China globally is the economic performance is not great. One data point I heard last week at IE Week from one of the sort of world's leading energy analysts on a public stage was that China growth numbers have to be taken and halved. That 5% declared, actually growth is probably at best 2 to 2.5%. I'm wondering, within the context of China, with the China National People's Congress meeting, is there expectation? Is it a big story that they're meeting? Do the people wait to see, what will they give? Is there pressure that they must deliver something to elevate the people? They, as you said, give a wider incentive to the wider group of people. I'm just trying to understand what the sentiment on the ground is for the government to do more to help stimulate the economy.
Well, yes, there are expectations, particularly by private companies. As we talk about the development of private companies in the last podcast I joined, well, Xi Jinping said that he encouraged the development of private companies, and more measures are expected to be rolled out this year to boost the development of private companies. As we know, China now relies a lot on high-tech development and innovation. And you know what companies are most innovative in China? Not state-owned companies, only private companies. And when people hear that Huawei, such a big giant, is a private company, they were surprised. They was wondering, is this really a private company, not a state-owned one? No, actually, the strongest, the best company in China are private companies. And if state-owned companies are playing on a level field with them, they cannot compete at all, not at all. So the most innovative company in China are private companies. So they need to rely a lot and more on private companies to give a boost to the country's economy. Well, they are not playing on a level field, but they need to make the field increasingly level for private companies. Yes.
And in that regard, we are expecting this week the Chinese National People's Congress, I mean, putting aside whatever people's expectation is, the sort of general reporting indication seems to be that the Chinese National People's Congress, the leadership, the political leadership of China, will once again set out the target of 5% GDP growth for the year. Is that correct? Does that seem to be the consensus position?
Yes, well, that's widely expected. And now all the Chinese provinces had announced their targets for the GDP targets for 2025. And it was the average of 5% for 2025. So we expect the country will announce the same GDP growth target. It's very important because it's important to maintain certain growth to keep up with to maintain social stability, to ensure job employment. But at the same time, the country is now pushing forward with some structural adjustment, kind of structural transition. So it needs to combine these two. And as you know, well, we are now in a time we face a lot of challenges, well, not just domestically, but also internationally, including the tariff from the United States. So the country needs to strike a balance between this industrial transition and certain growth to ensure job employment, yes, and stability, yes.
Michelle, the other big story last, or certainly big talking point last week in IE Week was just picking up on the sentiment you mentioned, are we getting to near the end of the price cap, the $60 G7 price cap on Russian oil, which has sort of been made redundant just by the market fundamentals of the price range dropping down, with Brent sort of having a ceiling in the low 70s that by market dynamics puts euros below the $60 level. But in terms of the wider sort of political view on whether Europe would return to Russian diesel in particular, Russian gas. There's reports in the FT today about some kind of a new investment to rehabilitate the Nord Stream 2 pipeline. I'm just sort of coming to my question, which is, are we seeing any sort of cuckoo in the coal mine reflected in shipping that is telling us that these crazy inefficiencies we've seen in the movement of energy around the world over the last few years is entering its end game?
No, we haven't. And I think if we want to see about what would happen post sanctions for Russia, we have to look at what happened when the sanctions were removed from Iran. I think it was back in 2016, 2017. And back then, yes, shipments of Iranian crude did resume to Europe, but it took about a year for everything to recalibrate and for people to be comfortable. And I think you can use that as a benchmark for how long, at minimum, that would take for Russian supplies to come back. But I think also it depends on whether or not the type of agreement that's put together and whether or not there's unity amongst the European Union. It may be that there may be some countries that are comfortable with the risk. I mean, Germany, for example, they were a major importer of diesel from the Baltic. Will they decide to remain independent now that they have found sufficient sources elsewhere, or will they go back? I mean, it's a question, for the traders and for the market as well. But I think also the government will
well, if it's legal, you'd imagine they would, right? If it's legal, the commercial decision would have to be the most commercially efficient way to do business.
You would think so, but I mean, the world now is so mercurial, and I think also there's this whiplash in decisions that we're seeing from the US, for example. So I think that injects more volatility and uncertainty than we would typically have seen if we were just looking at a period in time like post Iran, where I think things were far more straightforward.
Just picking up on that theme, Michelle, looking at the Red Sea, which has been kind of the beneficiary of what is now, I think, about a 6-week Israel-Hamas ceasefire at the end of phase one. Are we seeing any normality return to the Red Sea flows?
We're seeing, no pun intended, we're seeing a testing of the waters. We're seeing some ship owners sailing through with 1 or 2 ships just to see whether or not it's straightforward. So I think who knows what's happening with the situation in the Middle East, things, if things do resume, then obviously I think the Houthis have indicated that they will again begin attacking Western affiliated commercial ships. But for the time being, I think it's gradually returning. Not
So
in huge numbers.
is the insurance premiums that one has to pay to go through the Red Sea, is that still elevated because of this crisis? It hasn't returned, and so the incentive for ships to do so is not great?
I think the insurance cost really doesn't weigh on the freight cost and affect that commercial that commercial decision. But definitely there is a feeling that the appetite risk is, more comfortable amongst privately owned ships, certainly not for US listed ships at the moment, because they see themselves as greater targets. But definitely, give it a couple of months, and I think we'll see perhaps another 10%, 20% back going through the Red Sea for now.
Let's go to the survey question, which is tracking this development this week in China with the meeting of the China National People's Congress. I suppose the question is, what is the expectation for the stimulus to be of a scale that will lift consumer consumption and energy demand in China? We're seeing reports that the sort of difference from last year, if you like, is the budget deficit. The Chinese government did a 3% budget deficit last year. They're going to go to 4% budget deficit this year in their announcement this week. That doesn't seem like bazooka to me, but is there still a wait and see on how significant the tariffs will be from the US? Another 10% coming tomorrow. So my question is, will this Congress deliver the bazooka stimulus to lift consumer energy and demand in China? Disagree or agree with that? Omar, looking at where you mentioned there the androgynous markets as a whole, financial markets as a whole. We saw periods last year when the energy markets were in elevated states. They did draw in a lot of the financial actors, funds that came into the market. Open interest was quite long. Your thoughts on where that is this year and whether that is likely to attract those actors back in? At the end of the day, there's still huge liquidity looking for return. Are the financial actors willing to come back into the energy markets?
Yeah, that's basically the bullish argument, right? So if you look at price, fundamentally, if you just take price and look at it historically, where it is in real terms, all that kind of stuff, it's incredibly cheap. I mean, it's the cheapest thing out there of all commodities. I'm trying to think of one that's actually moved lower since 2022, and I don't think many have, maybe wheat, but in any case, nothing's been as weak as oil, or as sideways. So basically, oil is primed for a move, whether it's higher or lower, it's primed for a move. And that could attract a lot of money, especially if it breaks that support or breaks that resistance. You'll see a lot of money flow in, because if it breaks that support, then you're getting into what people say is like price discovery. You haven't seen price in that range for quite a few years, maybe going back to 2021. So that'll attract money, that'll attract price discovery, that'll attract movement to the downside. If you do break to the upside, that resistance goes back to 2023, and a lot of people are short the market. So if you break up, they'll all start to cover. And the interesting thing is that, people will tell them, yes, but, that means that, this is going to happen, and Trump will do this and do that. But the reality is, you'll hear people screaming, buy, because you need to close the position, no matter what. Doesn't matter what the, supply, demand, or what, shipping is doing, or what Trump is saying. It'll just move in one direction, and that's it.
Victor, I wanted to sort of get your views on obviously the big event happening this week in China, the annual meeting we've talked about, but also is the second 10% of Trump tariffs on Chinese exports to the United States. In the first tariff that was announced about a month ago by the Trump administration, the Chinese government didn't really react. They did some targeted counter tariffs. Your thoughts on this next round? Are we going towards a trade war of scale? Your thoughts on how the Chinese government is likely to react as this escalating trade tariffs are sent from Washington?
Well, when the tariffs go up, well, there will be negative impacts on China's exports to the United States. For instance, its exports to the United States could have gone up faster, but still it was growing in 2024. Without the additional tariff, well, would be higher, the growth. So now this has curtailed the growth of China's exports to some degree. And China has rolled out some countermeasures, for instance, raising the tariff on US crude. And as we know, China imported close to 10 million metric tons of crude from the United States last year. That was not very large, but there's still quite some volume. And in 2025, its imports from the United States will probably drop because of the additional tariffs too. So this would impact negatively the two countries' trade to some degree, that's for sure. And China has been,
China does import a lot. China does import a lot of agricultural products from the United States.
Yes, and it's also looking for alternatives too, has been doing so. So such as from Brazil and some other countries, well, so long as they can find alternatives, yes.
We also saw, just to follow up on that, despite all of this stress the Chinese economy is under and this sort of oversupply capacity of real estate problem and others, that we still saw the PMIs for manufacturing come in for February today over the weekend, and they went to positive. Manufacturing in China moved to growth. It's an amazing data point, which indicates that there's still life in that old dog yet, as the saying goes.
Yes, 50.2 for last month, yes. Well, and it's now kind of resuming. I mean, the industry, the confidence is coming back gradually, particularly after the Chinese New Year. And most companies, for instance, in Guangdong province, well, over 98%, I think the number may be that so, and had come back to work after the Chinese New Year. Most were basically large companies had resumed work, and those who had not come back are really small ones. So the industry activities are coming back, yes.
Michelle, last word to you. I wanted to get your thoughts, maybe a little bit outside your immediate sort of area of particular expertise, but geopolitically, sitting in Australia, given the dynamics over the weekend of what we saw in Washington, what appears to be a rupture in the Western Alliance in Europe, America at least. Of course, Australia is a big part of that Western Alliance and that U.S. protection tent, a security tent. How does this look from there? Is there concern? Is there a change in dynamic? Any perspective from Australia that might be useful?
Sure. Well, Australia has what we call AUKUS, which is an alliance with the UK and the US. And at the Friday meeting, I think Trump was asked about AUKUS and he actually didn't know what it was. So that's probably not a good start. But I think a lot of our defense expenditure is wrapped up with the US, and it's very hard to disentangle. And I mean, I have to say, I felt like I was in the 1984 novel when, after hate speak, Big Brother changed alliances like that, from Oceania hating Eurasia to hating East Asia overnight. And I think the complete flip to what's perceived as support or parroting, the words of Putin, has really spooked Australian politicians. And of course, Australia's about to head into a national election. So it has been quite the ride, even here from Australia, to watch what's been going on in the US.
Yeah, I mean, it's certainly, I think, obviously a lot to play out, and events on Friday were just, so this is a 50-50 room on the expectations for this Chinese National Congress. I suppose that echoes Omar's one day I'm a bull, the next day I'm a bear. I think he's not alone in that reality. We're all got a bit of whiplash every day, even just reading the headlines when up is down and down is up. And that's the nature of where the world is at. And in the middle is an oil market that appears a little bit frozen. And yet OPEC Plus, we didn't even mention, has to make a big decision this week as to whether they will continue with their plans to increase supply from April 1st or will extend their existing cuts another quarter or two. So they're caught, maybe like the rest of us, a deer caught in the headlights here of how to make that decision. General consensus seems to be that they will abandon plans to increase supply from April 1st and will extend the cuts. As they said, that we're pragmatic, not dogmatic. So following that thesis, one would think the cuts to extend. Listen, we'll wrap it up there with Brent at $73 a barrel. Thank you so much, Victor Yang in China, Omar Najia in Dubai, and Michelle Weiss-Bachmann in Adelaide, beautiful Adelaide, Australia. Have a great week, everybody, and we'll catch up with you all soon again. All the best. Thank you.
Yes, all the best.
Ramadan Kareem.
Ramadan Kareem.